we're going to put on chart right now a chart from your crowded market report. What are the red bars? What are the blue bars? What are the yellow bars? And yeah, can you just explain the difference between speculators and commercials, and then large and small speculators?
Okay. And I'll also note that, I do videos on YouTube every week, and we get this question a lot. So I have done a video on YouTube about this specific thing. And those are obviously all free and all that. But in general, when you open up a futures account, you have to declare yourself if you are a commercial trader, which means you're a farmer and you're hedging, your wheat production, or you're a gold miner and you're hedging your gold production, right? You get to put up less margin. So you want to declare yourself as a commercial trader, right? So that's what the red bars are. Those are the commercial traders, right? And then everybody else gets thrown into being a speculator. Now, if you are a speculator and there's a limit in each market. I don't know what they are offhand, but let's just say, since we're looking at S&P, 500 S&P contracts. If you have 500 or more S&P contracts, you are declared to be a large speculator, which is the blue line. Right? Because you have to declare when you go above those numbers, hey, I'm above those numbers. And this is sort of the CFTC's way of trying to avoid having people corner a market, right? And everybody else, me, you, everybody else that doesn't have 500 S&Ps on, that has 2 S&Ps on or whatever, is the yellow, which are small speculators. So those are the 3 groups there. And the way I look at it is the commercials are hedging, right? So there should be a cost to hedging, right? Hedging's not free. There's a cost to it. Okay, you're hedging your production, but you're giving up something to do that. So commercials should not make money, and therefore the speculators will make money off of that, given that they're opposite the commercials. And that to me is trend following. If that weren't the case, then speculators would never be in the market, so there would be nobody for the commercials to hedge to, right? So that's trend following, and trend following over time makes money. But at the extremes, when speculators are so loaded into a trade, that's when markets turn. And that's where I operate, right? Is kind of at those market turns. So like you can see here, if you go back to the fall, sure, the blue line was short. So speculators were short, but the market kept going down because that was trend following, getting paid. But then it started to get very extreme. And that's where I'm looking to go the other way. I hope that makes sense.
Thanks, Jason. Yeah, let's put on another chart, which actually can show this in some detail. So red is commercials who produce the underlying, and speculators are blue or yellow. Large are in blue, small are in yellow. So if you produce the underlying commodity, it makes sense that you will always be short. If you're a gold miner, you're never going to be long, buy gold futures. You're going to be shorting gold futures.
It is extremely rare, not impossible, but extremely rare to see that red line go positive. So this makes a good point. Why am I short gold? Because I'm looking for extremes. And if you're to eyeball this chart, you could say, well, this was much more extreme back in March of 2022 than it is now. So why am I shorting it now, right? So what you have to do in gold, it's good that you brought this up because it's the perfect example. You take this data and you have to index it, right? So I index it. And when you're indexing it, you have to pick a length that you're indexing it for. Like an RSI, for example, which most people are familiar with, is an index, right? So
relative strength indicator.
Right. So you're looking at 14-day RSI, 60-day RSI, 250-day RSI. Which one are you going to pick, right? So I had to pick one, right? And for gold, it's like 6 to 8 months, all right? So you can see that starting a few weeks ago, these commercials, the red guys, were the most short that they were in 6 to 8 months. So my index will then show, hey, that's maximum short for them. So I'm looking to get short.
Who do you want to follow? Who do you want to fade? If commercials are short, speculators by definition will be long. And that's the thing.
I'm fading the large speculators at the extremes.
So you fade the blue line at the extremes, and the blue line plus the yellow line will always equal the red line. So it always sums to zero. Large plus small speculators equals
correct. The negative. Now I need all 3 to be at extremes. You'll find times when the commercials are super short, the large traders are super long, but the small speculators are also short. I avoid that. And people are like, well, the small speculators are such a small part of it. Why is that? It just is what it is. When you test these individual people, these individual members, small speculators by definition are the worst traders there are. So I never want to be on the same side of them, right? And I think a good example of that one recently, and you could probably pull it up, I don't know, but is the bonds and the 2-year notes, where you have some of the most ridiculous sizing in 2-year notes right now by large speculators. They're so short, and commercials are so long. So you would think, well, maybe it's time to get long the 2-year notes. But the truth is, the small speculators are also long. So I don't want to get long, right?
Right. So we've got this is, I think, your index from Credit
Right.
Market
So you look at
Report.
the 2-year notes, commercials super long, large speculators super short,
Yeah.
right? So you're thinking, okay, buy 2-year notes, but you see the small speculators are also super long. So this has kept me out of getting into that trade, which has been to this point fortunate because 2-year notes keep going down. This is all about, the commitment of traders is not some kind of magical thing. All right. It doesn't work all the time, first of all, which is why you have to get into risk management and trade management and all that. But A, it doesn't work all the time. But B, what I find is what it does best is keep you out of trouble, if nothing else, right? So here the small speculators are keeping me out of trouble, right? I'd love to buy 2-year notes, but small speculators are too long, so I'm just staying away, And I trade 37 markets, and each one of them moves every single day, right? And I'm usually in maybe 2 or 3, maybe 4. I think right now I have 1, 2, 3, 4 trades on, okay? Which means I have 33 markets that I have no trade on. And you know what? They're moving every day, up or down. So I could be making money long or short and all these different things, but that's irrelevant to me, right? I'm focused just on the ones that give me what I have found to be the best risk reward over time for my portfolio. That's it. The rest of it is all just noise to me.
I've got a question about, I guess the only way I can use it is like sort of the basis trading and the ways you can get long. Like if I want to be long stocks, long the S&P 500, I could do the very time intensive way and save on the ETF fees and just buy literally every single stock. 6% Apple, 5% Microsoft. Takes a lot of time. I can buy SPY. I can buy proxies. There are other ones. VOO, I think perhaps has a lower by tiny bit expense ratio. Or I could be long the futures, S&P 500 futures. 80s and 90s, as really these futures traders got very sophisticated, got a lot of bigger. Is it correct that the commitment of traders only looks at the latter, only looks at the futures?
Only looks at the futures. That's correct.
Yes. Okay. So if someone could be shorting the S&P 500 futures, but they're long SPY and they're profiting from the arbitrage or something like that.
There won't be an arbitrage.
Yeah. Yes.
That would never happen because you've got $80 trillion in investment banks that would close that arbitrage in 1 second. So there would never be that arbitrage.
Okay. So yeah. So how confident are you that what you're seeing here sort of is the market? Because futures
it is a subset of the market. And it's a good question because one thing that I've gotten when I used to raise money and I used to talk to allocators, right? And we would talk about this and they would say to me, yeah, but like with currencies, for example, the futures market is such a small part of the global currency market that how could that be giving you any information? And my somewhat obnoxious answer was, you know what? Currencies have been one of the top markets for me using the commitments of traders. So that's all I care about. Does it make me money, right? You want me to try and explain to you why that is? I can come up with with reasons, but the bottom line is it works. It's a sample is really what it is, right? It's a sample. And people are like, oh, well, you're saying that people are, for example, not now, but at other times, you're saying people are super short, stocks. Actually, yes, now. But we know they're long stocks, right? So they're just using the futures to hedge. I'm like, okay, but if you're long stocks and you're hedged by being short futures, then are you really long stocks? I never understood that question, right? You're not. I own $1 million worth of stocks and I'm short $1 million worth of S&P futures. I am not long stocks. I'm sorry, right? So I hope that kind of answers the question, but it's a sample,
Right. And I don't know, but in the stock world, futures are a larger percentage of, than in the interest rate world where it's a lot of like over-the-counter derivatives that aren't cleared.
Again, that's absolutely true. And even in the stock world, futures have got to be a very small, I don't know the number, but a very small percentage compared to the overall amount of equities that are out there, right? But it's a sample, just like any other sample. You do statistics, right? I don't know. You need 30 observations or whatever it is, right? It's a sample.
Right. It's a sample. And then what about the argument, and this is the note I took earlier, that all stocks are owned all the time? the S&P 500 is always 100% owned. If there's 5 million issued shares of a particular stock, that is always 100% owned all the time. Yes, 5% of the float may be short, and those are hypothecated from people who are long the stock, who are lending it, but everything's always owned all the time.
That's true, but I don't know what that has to do with this. Again, it's owned all the time, but now they're massively short futures against it. So
but the commercials are long against it, so it always nets to zero.
It always nets to zero. That's correct.
Right. Okay. So in the that's why I wanted to go to gold, because it's pretty intuitively clear. I'm a producer. I produce gold, so I'm hedging it and I'm selling it. And you're a speculator. You're taking the other side. What about S&P 500 contracts? Who produces those contracts? And
I wish I could have a better answer for you on this one. I get this question all the time. Who are the commercials on the S&P? I really can't sit here and list to you who they are, but you just have to ask yourself, who would be able to say they are hedging their production? So it would be an investment bank. It would be maybe a mutual fund. Maybe it would be a commercial, right? Somebody like that, I assume, would be a commercial. Anybody who is not me or you, a speculator. Anybody who is not a hedge fund or a CTA or somebody like that. Those are all speculators. So investment banks, I would assume, possibly mutual funds, I would assume, are commercials.
And so let's say you have a scenario like we have now where, speculators are short the S&P 500, commercials are long the S&P 500. What is it about the commercials where you want to go with them and you want to fade the speculators? Why are the commercials right and the speculators wrong?
At extremes. I think it comes down to this. The majority of people that get into trading lose money. Can we agree with that?
Yes, 100%.
We would put the number at what? 95%?
Yeah.
All right. So let's say 95% of people that speculate in the markets lose money. So why don't we just figure out what those 95% are doing and do the opposite and make the money that they're losing? That's really at the core of it, all I am doing. I am not trying to be smart. I am not trying to be smarter than the market, because I'm not, and nobody is, right? I've tried in the past to do that, and all it got me was losing money, okay? All I want to do is make money. So if I know you, and I've watched you for 5 years, and you've put on 300 trades in those 5 years, and you lost on 295 of them, and you've lost 90% of your money, then why would I need to do anything else ever than just go opposite of what you're doing? In particular, if you're not changing what you're doing, if you're still doing the same thing, thinking it's going to work, right? Then why would I need to do anything else except take the opposite trade of you? It's like if I could get on the same side as one of the people who wins. Stanley Druckenmiller emailed me his trades live time every day. Then certainly I would want to take the same side as that, right? But Stanley Druckenmiller doesn't do that. And nobody does that, right? But the people that do it are the people that lose. They're on TV all the time, yakking and showing and this and that and the other thing, right? And they show up, fortunately, on the Commitments to Traders as well, right? So that's really all I'm trying to do. All this other stuff about who is a commercial and who is this and why and that and why and that. I'm sure we can dig up and get some great answers to some of those things. But the truth is, my main answer usually is because it works. That's it. I'm just trying to make money. I'm not trying to write a book. I'm not trying to make an intellectual argument, right? I'm not trying to change financial theory. I'm saying if 95% of people who speculate in the markets are going to lose money over time, then I want to be opposite those 95% and I want to make the money they're going to lose.
It's that simple. So let's look at the S&P 500 and the NASDAQ futures. S&P 500, a lot less changes, I'm noticing, than the NASDAQ, which we'll show in a second. So where on this chart did you start to become quite bullish? And what would have to happen for you to stop being bullish?
For me to stop being bullish, I index this data. When that index goes to neutral, which would be a 50 reading, the index obviously goes from 0 to 100. When that index goes to a 50 reading, I get out. Not because it doesn't mean the market can't keep going up, but because that's my edge. They're super short, I get long. They're no longer super short, I get out. That's what I was trying to capture, right? And also, as an aside, that's my job, okay? I manage a CTA. Institutions give me money. Most of these institutions are fund of funds and fund of funds of CTAs, which means they have a lot of trend followers in their portfolio. So the trend followers get hurt at the turns. I make money at the turns. So they're getting a diversified portfolio, or I'll make money where those guys are losing. Then once this sort of goes neutral, I'm out And that's where the trend followers are getting long. And that's their trade. That's their job. My job is this, their job is that. I'm just doing my job, right? Which is catching the turn and that. So it's a combination of those two things. One, it's my job. And two, the edge is gone. So like if you look at the NASDAQ, for example,
Yeah.
the NASDAQ is what I got long first earlier in the year, right? This is currently, but so you can see there, right? You see starting in about late January where the red started to really poke up a lot.
Yep.
That's where I started getting long NASDAQ. All right. And then as it came off into sort of late March, they're now neutral. So I'm out of my NASDAQ. But what ended up happening is they ended up sort of buying NASDAQ and selling S&P, right? So then I started getting long S&P. Now, you can look at this and be like, oh, but Jason, the NASDAQ has been outperforming even since this has happened. And that's absolutely true. Okay. There's no, I wish that I had stayed long now. I don't wish, but it would have been better to have stayed long NASDAQ here because the NASDAQ has continued to outperform the S&P. But so what? To me, the risk reward was S&P because that's where they were more short. So that, and just because you see the speculators have gotten long here and the NASDAQ has continued up. Correct. Okay. But that's not my trade. That's the trend follower trade from here, right? When they get super long, which for all I know could be this week, that's when I will be looking to get short, but not until then. And they have a while to go before that blue line goes up to extremes and that red line goes down to extremes. And if you look, the yellow line, the small speculators are still short NASDAQ. So all those things are going to have to flip and go to extremes for me to start thinking about getting short NASDAQ. And don't get me wrong, I can't wait.